Hello, this is Elizabeth Pluswick, and we're continuing to work with cash flows and how cash flows can be used to compute payback period. And this is a real quick and easy way to estimate how long it takes to recoup the initial investment from a project. So it's commonly used and it's pretty easy to calculate. So let's take a look at a couple of different situations to compute payback period. Payback is defined as the period of time. So the answer is going to be in years and months, the period of time for the benefits of a project. And benefits are generally the cash in, right? Cash flows in. The benefits of a project to equal the cost of the project. And the costs are cash out. So we'll use those words costs and benefits. So just so you know, benefits are cash flows coming in, and costs are cash flows going out. All right, so again, how long does it take for cash inflows to equal the cash outflows? And the answer is the payback period. How long does it take? So let's look at a couple of examples of that. Earlier we used an example with we purchased a machine for $5,000, initial cost of the machine. And by the way, when we say initial cost of the machine, that includes the actual invoice cost of the asset. Plus, be sure to add on to this, to get to this total, the actual cost of the machine includes freight of the asset coming to the plant, to the factory. It includes sales tax. That's probably already added on to the invoice, but if it isn't, make sure you add on sales tax. Any setup costs required to get that machine up and running. So if plumbing or electrical or any other kind of setup costs need to pour a cement pad in the factory to hold that machine, all of those costs go into this number, the initial cost of getting the machine at your facility ready, up and running, ready to go. So include all those costs in getting to this initial cash outflow at time zero. So once we have the cost of the machine, then in a previous example, we had cash flows of $150 from each year, net cash flow coming in. So to do payback, you just add up these cash flows for the whole life of the machine. So this is fairly low cash flow in, only adds up to $450 net cash benefit from owning the machine and using it for those 3 years. Plus at the end of the life, remember, we sold the asset for $1,000 at the end of year 3, so that's an additional cash benefit. So when we buy this asset, we have initial cash out of $5,000 and we have total net cash coming in of $1,450. The benefits from owning and running this machine never exceed the cost. The benefits are lower than the cost. So this asset never achieves payback. There is no payback period. The benefits never reach the level of the cost of the machine. So perhaps there were some other qualitative reasons that the company bought this asset. From a financial statement here, from a financial standpoint, it doesn't really make sense. There must have been some other qualitative aspects, such as safety, morale, some other thing like that caused the company to buy this machine. Financially, it didn't make sense. Never achieves payback. Okay, so let's look at an example that does make sense, where the company does achieve a payback period. And there's two situations. The payback from the machine can even have even cash flows, and that means the same amount of cash flow coming in every year, or they can be uneven cash flows, where the amount of cash flow differs from year to year. So let's first look at one that has even cash flows. $5,000 initial cost. Every year for 3 years, the net cash flow coming in from this asset is $2,000. Net cash flow coming in, we assume at the end of each of those 3 years. And you simply add them up. So at the end of year 2, we've achieved what? A total of $4,000 net cash in. Has that reached our initial cost yet? Nope, not quite yet. We need a little bit of year 3's cash flow. And in fact, we need half of year 3's cash flow, right? We're at $4,000 net benefit. We need to come up to $5,000 net benefit to equal the initial cost. So we need half of this next year's cash flow, or we need half of it, or $1,000. So $4,000 up to that point, plus $1,000 of year 3's cash flows equals our $5,000 net benefit. And so we can say then at the end, halfway through year 3 is when we achieve payback, cash in that equals our initial cost out. So 2 years plus 1/2 of year 3's cash flow, and we achieve that benefits equal the initial cost. So you might say that as 2 years and 6 months, or 2.5 years is the payback period. Just add up the cash flows until the net cash in equals the initial cost out to buy that machine. Now, I have a little shortcut, a little trick for you. When cash flows are even, the same amount every year, there's a little formula that's a lot faster to do than that whole schedule. When the cash flows are the same, you can use this. Put initial cost of the asset in the numerator, divide by 1 year's cash flow, remember, because they're all the same, and that's $2,000 in this example, and then just divide. So payback then is 2.5 years, and that's the same answer we came up with our columnar, plotting of the same information. So use this shortcut formula when the cash flows are the same every year. What do we do in most cases, the cash flows are not the same every year. So how do we handle that then? We can compute payback with uneven cash flows simply by plotting them out in a formula, in a column like we did earlier. So we start out with the initial cost of the machine. Here we have year 1, 1,000. Year 2, 2,000. Oh, have we achieved payback yet at the end of year 2? Add them up. We're at 3,000. Nope, not quite, haven't gotten 5,000 yet. So we go on to year 3. There's another 1,000 net cash coming in year 3. Accumulate them. Have we achieved payback yet? 4,000. Nope, not quite up to 5,000 yet. So we go a little bit into year 4. Okay, it looks like year 4 has sufficient cash flow that we will achieve payback partway through year 4. So we're sitting at $4,000 benefit at the end of year 3, right? Cumulative at the end of year 3. Plus, we need to go partway into year 4's cash flow. We need $1,000 more, right? We're sitting at $4,000 net benefit. We need $1,000 more till we get to $5,000, our net initial cost. So we need what? This total, we need $1,000 to get to $5,000 out of year 4's cash flow. Total is $3,000. So we need the amount, we need all the cash flows that happen through year 3 plus 1/3 of year 4. And so that would be, payback would be 3 years plus 1/3 of year 4 cash flow. So that equals 3.3 years, or 3 years and 4 months. So that's the payback period for this asset with uneven cash flows. And that's a summary of payback analysis.